September 17th, 2025. Jerome Powell walks into the Federal Reserve meeting room at 2 p.m. Eastern, and by the time he walks out just 2 hours later, he's just shifted billions of dollars in the market and created what could be the biggest investment opportunity of the year. But here's what nobody is talking about, and this is going to blow your mind. When the Fed cuts rates after an extended pause like this, small cap stocks historically return 35% in the following 12 months, compared to only 23% for large cap stocks. That's a massive 12 percentage point difference that most investors completely miss. Let me put this in perspective for you. If you have $10,000 invested right now, the decisions you make in the next 30 days could determine whether that becomes $12,300 or $13,500 by next September. That's a $1,200 difference on just 10 grand. And if you're working with larger amounts, we're talking about tens of thousands of dollars in potential gains that are sitting right in front of you. I'm going to show you exactly which sectors are about to explode, which ones you need to avoid completely, and the specific ETFs that could potentially double your returns during this rate-cutting cycle. We've got historical data, we've got the numbers, and more importantly, we've got a clear action plan that you can implement starting today. So stick with me, because this is not just another market update. This is your roadmap to potentially life-changing returns. Now here's where this gets really interesting, and why this rate cut is completely different from what most people think. When Powell announced the 25 basis point cut, bringing rates down to 4.00% to 4.25%, he didn't celebrate. Instead, he called it risk management. That phrase should have every investor's ears perked up because it tells us everything we need to know about what's really happening behind the scenes. Let me walk you through the economic detective story that led to this moment. In August 2025, the jobs report came in with only 22,000 jobs added, and they were expecting 75,000. That's not just a miss, that's the weakest job growth we've seen since 2020. The unemployment rate jumped to 4.3%, and suddenly the Fed realized they might be sitting on a ticking time bomb. But here's the plot twist that makes this so incredible for investors. Inflation is sitting pretty at exactly where the Fed wants it, with just 0.2% monthly increases. This creates what economists call the Goldilocks scenario. Growth is slowing enough to justify rate cuts, but inflation is controlled enough that they don't have to worry about reigniting price pressures. But the real kicker is this. The Fed had paused rate cuts for 10 months since December 2024, and when they resume cutting after a pause like this, history shows us something remarkable happens to certain sectors of the market. The last time we saw a post-pause cutting cycle like this, small cap stocks absolutely exploded. We're talking about the kind of returns that separate the wealthy from the middle class, and it's happening right now, right in front of us. The Russell 2000, which tracks small-cap stocks, has already gained over 5% just since Powell's Jackson Hole speech in August, and we're just getting started. The small-cap goldmine. This is where we get to the meat of the opportunity, and I want you to pay close attention because this could be the most profitable information you hear all year. Canaccord Genuity, one of the most respected research firms on Wall Street, analyzed every post-pause rate-cutting cycle going back decades, and what they found is absolutely staggering. Small-cap stocks deliver average returns of 35% in the 12 months following Fed rate cuts that occur after extended pauses, compared to just 23% for large-cap stocks. Now, why does this happen? It's actually pretty simple when you break it down. Small companies carry higher debt levels relative to their size, and they're much more reliant on bank financing compared to large corporations that can issue bonds or tap credit markets directly. When interest rates fall, small companies see their borrowing costs plummet, which directly flows to their bottom line. It's like giving them an instant profit boost while simultaneously making their future earnings worth more in today's dollars. But here's the opportunity that's staring us in the face right now. While the S&P 500 is sitting at all-time highs, small-cap stocks are still trading significantly below their November 2024 peaks. This creates what we call a technical setup, where you're getting into quality small-cap companies at discount prices just as the fundamental catalyst falling interest rates is about to kick in. For specific plays, you want to focus on 3 ETFs that give you the best exposure to this trend. First is IWM. The iShares Russell 2000 ETF, which is your broad market small cap play and the most liquid way to capture this entire sector. Second is AVUV, the Avantis US Small Cap Value ETF, which focuses specifically on undervalued small cap names with strong fundamentals. These tend to outperform even more during rate cutting cycles. Third is GSC, the Goldman Sachs Small Cap Equity ETF, which gives you professional active management specifically targeting the best small cap opportunities. Imagine you had invested $5,000 in small caps during the last post-pause cutting cycle. Based on that 35% historical average, you would have made $1,750 in profit in just 12 months. Now multiply that across your entire portfolio allocation, and you start to see why this opportunity is so massive. The tech renaissance. Now let's talk about the second major beneficiary of this rate-cutting cycle, and that's technology stocks. But I want you to understand exactly why this happens, because when you grasp the mechanism behind it, you'll see why this isn't just hype. It's mathematical certainty. When interest rates fall, the discount rate that investors use to calculate the present value of future earnings also falls. For technology companies that generate most of their profits years into the future, this creates an immediate boost to their current stock valuations. The signal we got from Europe was incredibly telling. The day after the Fed cut rates, technology stocks led gains in European markets with a 2.1% surge. That's not coincidence, that's global investors immediately repositioning for lower rates. Goldman Sachs Asset Management put out a note explaining that growth companies can now finance ambitious projects much more cheaply, which means they can invest more aggressively in research and development, acquisitions, and expansion plans. For capturing this tech upside, you want to focus on 3 specific ETFs that give you the best risk-adjusted exposure. VGT, the Vanguard Information Technology ETF, offers comprehensive sector exposure with an ultra-low 0.09% expense ratio. That means more of your returns stay in your pocket instead of going to fees. XLK, the Technology Select Sector SPDR fund, is highly liquid and focuses on large-cap tech leaders that tend to outperform during the early stages of rate-cutting cycles. And SPYG, the SPDR S&P 500 Growth ETF, gives you broader growth exposure that captures technology upside while providing some diversification across other growth sectors. Here's the compounding effect that most people miss about technology companies in a lower rate environment. These companies don't just grow faster when borrowing costs fall. They compound exponentially because they can reinvest their cheaper capital into higher return projects. It's like giving a rocket ship more fuel while simultaneously removing the gravitational pull that was holding it back. The REIT revolution. Real estate investment trusts represent what I consider the most direct play on falling interest rates, and they benefit through not just one, but 2 powerful channels that most investors don't fully understand. First, lower rates reduce financing costs for property acquisitions and development, which directly improves REIT profit margins. Second, and this is huge, REIT dividends become more attractive relative to competing fixed income investments like bonds and CDS as those yields fall. The Vanguard Real Estate ETF, ticker VNQ, currently yields 3.84% annually with just 13 basis points in fees. That means for every $1,000 you invest, you're getting $38.40 per year in dividends, and that's before any price appreciation. But here's where it gets really interesting. As mortgage rates decline following Fed cuts, housing market activity increases, which drives up property values and rental income for the underlying REIT holdings. Historical data shows that real estate securities consistently outperform during rate-cutting cycles, and there's a specific pattern that plays out. In the first 3 months after rate cuts begin, REITs typically outperform the broader market by 2 to 3 percentage points. Then, as the rate-cutting cycle continues and mortgage rates fall further, you see accelerated outperformance as both individual and institutional investors pile into real estate investments. What makes this opportunity even more compelling is that many REITs are still trading below their pre-rate hike levels from 2022, even though their underlying properties have maintained or increased their values. You're essentially getting high-quality real estate exposure at discount prices, just as the fundamental tailwinds are about to kick in. The math on this is pretty straightforward. Lower financing costs, plus higher relative dividend yields, plus increased property values equals significant total returns for REIT investors. The bond strategy shift. The bond market is where we're seeing some of the most sophisticated money managers completely repositioning their strategies. And if you understand what they're doing, you can ride their coattails to substantial profits. Investment-grade corporate bonds are currently offering yields around 5%, which provides meaningful income potential with a built-in cushion against volatility. But the key insight that separates professional bond investors from everyone else is understanding duration risk in this particular cutting cycle. The sweet spot for bond investing right now is the 5 to 10-year duration range, not the ultra-long duration bonds that many investors think will benefit most from rate cuts. Here's why. This cutting cycle may not produce the dramatic yield declines we saw in previous recessions because the economy isn't collapsing, it's just slowing. The Fed is making preemptive moves to ensure a soft landing, which means intermediate duration bonds will capture most of the upside without the extreme volatility of longer-term securities. For implementing this strategy, focus on 3 specific ETFs that give you professional-grade bond exposure. BRTR, the iShares Total Return Active ETF, is managed by BlackRock's Rick Rieder, who's widely considered one of the best bond managers in the world. This gives you active management that can navigate the changing rate environment in real time. GSST, the Goldman Sachs Ultra Short Bond ETF, provides short-duration exposure that captures falling rates while minimizing volatility. And AGG, the iShares Core U.S. Aggregate Bond ETF, gives you broad market exposure for your core bond holdings. The yield curve is showing signs of steepening, which means short-term rates are falling faster than long-term rates. This steepening environment typically benefits financial institutions and supports broader economic growth expectations, which creates a positive feedback loop for the entire rate-cutting cycle. Bond investors who position correctly for this steepening can capture both capital appreciation and attractive current income. The sector winners and losers. Let me walk you through the market's new hierarchy and show you exactly which sectors are about to win big and which ones you need to avoid completely. Consumer discretionary companies are positioned for significant outperformance because lower borrowing costs reduce financing expenses for big-ticket items purchases and improve consumer confidence. The S&P 500 consumer discretionary sector has already gained nearly 26% since the Fed's previous cutting cycle began, and we're seeing specific examples of this playing out right now. Walmart shares are up 15% year-to-date, Home Depot is up 9%, and these aren't coincidences. They're the direct result of consumers having more purchasing power when credit card rates and personal loan rates decline. Every percentage point drop in consumer borrowing costs translates directly into increased spending power, which flows straight to the bottom line of consumer-facing companies. The financial services sector presents a more complex but incredibly lucrative opportunity for investors who understand the dynamics. Regional banks face some pressure from compressed net interest margins as short-term rates fall, but larger financial institutions benefit massively from increased lending activity and improved credit conditions. The KBW Regional Banking Index has risen approximately 1.5% since Powell's dovish remarks, while the S&P 500 Banks Index has surged nearly 5%. Here's the historical pattern that should get every investor excited. CFRA research shows that during the second year of monetary policy easing cycles since 1990, U.S. financial stocks have appreciated by an average of over 20%. We're not just talking about modest gains here. We're talking about sector-defining moves that create wealth for investors who position correctly. Dividend-focused strategies become increasingly attractive as cash yields decline throughout the rate-cutting cycle. The ProShares S&P 500 Dividend Aristocrats ETF currently yields 2.46% compared to the S&P 500's 1.12% yield, and these dividend payments become more competitive relative to money market funds and short-term bonds as those yields fall. Morgan Stanley research shows that stocks typically outperform by an average of 3.1% 6 months after a company announces a dividend increase, making dividend growth stocks a key focus area during rate-cutting cycles. The money rotation story that's happening right now is massive. Institutional investors are pulling money out of cash positions and short-term bonds, and that money has to go somewhere. History shows us it flows into exactly the sectors we've been discussing: small caps, technology, REITs, and dividend-paying stocks. Now let me give you the exact portfolio allocation that captures all of these opportunities while managing your risk intelligently. This is what I call the 40-30-20-10 strategy, and it's based on historical analysis of what works best during Fed rate cutting cycles. 40% of your portfolio should be in growth-oriented holdings, split evenly between small-cap stocks at 20% and technology growth stocks at 20%. This gives you maximum exposure to the two sectors with the highest historical returns during post-pause cutting cycles. 30% should be allocated to income-generating assets, divided between REITs at 15% and high-quality dividend stocks at 15%. This provides steady cash flow while benefiting from the rate-sensitive sectors that outperform during easing cycles. 20% goes into fixed income, focusing on intermediate duration bonds and high-yield credit that captures falling rates without excessive duration risk. And finally, 10% stays in defensive positions, like cash and short-term instruments, giving you flexibility to take advantage of any volatility or new opportunities that emerge. This allocation balances the significant upside potential from rate-sensitive assets while maintaining adequate diversification to weather any potential market volatility. The key is understanding that we're not betting everything on one outcome. We're positioning for the highest probability scenario while protecting against the unexpected. But let me be crystal clear about the risks you need to monitor. The primary concern is whether the economic slowdown that prompted these rate cuts proves more severe than anticipated, potentially leading to recession rather than the Fed's desired soft landing. Additionally, persistent inflation pressures from tariff policies could limit the Fed's ability to cut rates as aggressively as markets currently expect. The newly appointed Fed Governor Stephen Moran's dissent in favor of larger rate cuts suggests there's potential political pressure on monetary policy decisions that could create unexpected volatility. Everything is lining up for what could be an explosive year-end rally in small-cap stocks and growth-oriented sectors. The institutional money is starting to flow, the fundamental catalysts are in place, and history is on our side. The Fed has signaled at least 2 more rate cuts before the end of 2025, with potential for additional cuts in 2026. Professional investors are rebalancing their portfolios for this new rate environment. And when institutional money moves, it creates the kind of momentum that individual investors can ride to significant profits. Treasury yields have already fallen from 4.30% to 4.06% in just a few weeks since the Fed's pivot became clear, and early movers are already capturing gains. The Russell 2000 Small Cap Index is up over 5% since Jackson Hole. Technology stocks are outperforming globally. And we're just at the beginning of this cycle. The question isn't whether this strategy will work. The historical data proves it does. Small caps returning 35% during post-pause cutting cycles. Technology stocks benefiting from lower discount rates. REITs capturing both yield and appreciation. These aren't theories. They're documented patterns that repeat throughout market history. The real question is whether you'll act on this information or let this opportunity pass you by like so many investors do. Your window of maximum opportunity is right now, before the broader investing public catches on to what's happening. By the time CNBC is talking about the small cap rally and everyone's grandmother is buying REIT ETFs, the best gains will already be captured by the investors who positioned early. If this analysis opened your eyes to opportunities you hadn't considered, smash that like and subscribe button because I'm tracking every Fed move, every economic data point, and every market shift to keep you ahead of the curve. And I want to hear from you in the comments. Which sector has you most excited? Are you going after small caps for maximum upside, technology for growth potential, or REITs for that combination of income and appreciation? Let me know your strategy because your insights help the entire community make better investment decisions. The next few months could define your investment returns for the entire year. Don't let this opportunity slip away. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.